profit margins are at high levels, credit conditions favorable. I guess my question is it really sustainable? You know, we're also heading into the fall, which tends to be a dicey period for markets. We've had some ugly corrections in some
Sure.
falls.
The fall does tend to be a trickier time for the market, and especially with QE due to end in October with the taper. So there could be volatility in store, especially with geopolitical situations in the Ukraine and across the Middle East. But the fundamentals and what we look for in companies, we think the bull market is still intact for the time being. So while there might be volatility the next 6 months through the fall, we believe credit conditions remain favorable despite QE easing, and with corporate profit margins at high levels, we believe if interest rates remain at low levels, maybe a normal rate of 2% rather than 4%, we believe earnings should hang in there and allow the market to continue its favorable trajectory.
So let's get to some of your stock holdings. You do like a bit of a contrarian approach to your investments. You like out of favor names. Western Union is a stock that you
Sure.
do hold. But when you look at its valuation, pretty much every metric, EV, EBITDA, price to cash, it all trails its peers. So when I look at a stock like this, which is also underperformed, what are you looking at, or what are you seeing that perhaps the average investor isn't when they're looking at the numbers?
So Western Union is a very interesting company. It's got 17% market share of the remittance market, and we believe that the concerns about technological disruption are slightly overplayed. So if you look at what Western Union has in its favor, it's got 500,000 agents, an amazing network, and it sends money throughout all 200 countries. So we believe the business model is a lot more intact and strong than consensus believes, and therefore we believe earnings and the profitability and the cash flow are sustainable in that company. So we take a slightly different view on Western Union, that technological disruption isn't coming soon to that company, and its barriers to entry are sustainable.
All right, another stock you like is EMC. There's an activist investor, Elliott
Yes.
Management, just got involved buying some shares, wants EMC to get rid of VMware. Now, a lot of times when an activist investor gets involved, it is beneficial for shareholders. Will it be beneficial regardless of how this plays out?
I think that's right. Regardless of how it plays out, I think EMC stock looks attractively valued to us. And again, the barriers to entry for EMC are pretty strong, and they continue to invest in order to maintain their leadership in the storage market. So whether VMware gets spun out, we believe that will allow the company to buy back more shares, and the undervalued core business, people will see how undervalued it is if VMware was spun out. But if they keep the current business structure, the federation as they like to call it, we think the company can still do a lot of things to keep moving the business forward. So I think whether Paul Singer or Elliott gets his way of spinning out VMware, or whether the business remains intact with its federation structure, we think shareholders will be happy either way.
How about Pfizer? It is the cheapest among its peers, but it just had a big failed bid for AstraZeneca. Does it have to make another deal? What is Pfizer going to do to move the needle a little bit at this point?
Sure. Well, Pfizer are keeping quiet about what they're going to do with regards to AstraZeneca. They're under UK takeover panel restrictions, so they can't comment for 6 months. So it's unclear whether they will make another approach to AstraZeneca or not. What we like about Pfizer is we believe they've got optionality. They've got a very strong balance sheet, so it should allow them to do continued tuck-ins of firms or drugs, or go for a larger deal such as an AstraZeneca. But we believe the worst is over for Pfizer. They've had a lot of patent expiries on some of their headline drugs, and
They've also had some Lipitor lawsuits too.
Yeah, so Lipitor, it was a drug that was their big blockbuster. Right. It's now down to around about 2 billion of sales out of 50 billion. So Lipitor, it's less of a concern than it once was, given the fact that it's a smaller part of the business now. And you've lost these exclusivity of patents as they move to generic. But we now see the pipeline, some successful drugs coming out of the pipeline, and now there's a more balanced growth on the top line with new patent drugs offsetting the continued loss on the generics.
I want to ask you as well about Howard Hughes. Now, based on its price performance, it does not, to me, look like a value stock. It's in the real estate holding business. Why is that, in your view, something for your portfolio?
Sure. Well, Howard Hughes is a very interesting company. We bought it at the beginning of last year, and it's obviously done very well for us. So it's a case of looking at whether it's still a value name. And that's one where you've really got to look at it on a sum of parts basis. So it's not about the earnings or the cash flow right now. given its portfolio of assets. And we believe if you look at a sum of parts, there's still meaningful upside to what we believe is the intrinsic value of that company. So despite it doing so well, we're happy to continue running that position.
So it's not too late to get in.
No, I'd be happy buying here. We have recently added to that name despite its strong run. And if you look at the assets, they've got diversity, geographic diversity. So they own the Seaport Pier 17 in Manhattan here. They also own large acreage in Summerlin in Las Vegas, the Woodlands in Houston, and over in Honolulu. So they've got a great diversity of assets with great development plans for each of those assets.